Okay, started recording. Guys, can I ask that you use my UNISA email address to join the session? Otherwise, you will not have access to the recordings. So please use your my UNISA email address. Okay.
Deboho, sorry, what do you mean by using your UNISA email address? So we just clicked on the link, right? When we sign into my UNISA, we just click on the link.
Using my live email address.
Yeah.
I use my live email address.
That's fine. So guys, I'm just checking here. I had restarted my machine, so I'm opening my files now. Apologies for that. We got the provisional timetable for the October exams, not yet finalized, but it looks like I think our exam will be around the 27th of October. That's the date that they had on that timetable, but it's still not finalized. It can change anytime. So if you want to do the planning, I think for now you can work with that date. Okay, guys, can you see the presentation?
Yes.
Yes.
Mr. Level, before you commence.
Yes.
Yes, the recording of the 22nd of the first recording of this online class on the EPS. I saw you uploaded the presentation. I thought you would also upload the recording of the session itself.
It's loaded. I'll share the link. I'll share the link to that recording. I keep saying I'll do it, but I'll share that link. I'll do it immediately after this session.
Thank you very much.
But guys, I've been getting a lot of queries on EPS. So it looks like you guys are still struggling with EPS. Do you want to take a few minutes before we start just to talk about it?
Tebogo, maybe I mailed you earlier today regarding the purchase of the company. I just quickly want to see.
Oh yes.
Maybe we must just share that with them. It's Avovo Pty Limited, question 3.4. They didn't give us any information as to the funding instrument for that purchase of the company.
Yes, I saw that, Louisa. I thought of posting an announcement relating to that number 4. But I've got a lot of students that have already submitted their assignments. And what I did not want to do was to cause panic with those students. So in terms of number 4, I will mark it as the student approached it. Whatever assumptions that they've taken, I will mark on number 4. But I was reluctant to cause panic for, I think I've got about 80 students that have already submitted assignments, and I didn't want them panicking.
Hi guys, sorry, to get on the same page, what are you talking about?
Tebogo, maybe we must just, what you told me is that we will have a session to discuss that question.
Please,
I think
tell me what are you talking about?
Sorry. We're talking about assignment 2, question 3.
Question 3. Okay, that's what I'm trying to establish.
Polly?
the earnings per share question.
Yeah.
Guys, that question is very difficult. It's very difficult. It's as difficult as it gets. You will not get anything more difficult than that question. If you can understand the principles in that question, you'll be able to pass any per share question that are thrown in the exam. But I think I think after submission, we'll have a class on that particular question, just to go through that question and addresses the principles behind each and every point. Yeah.
I sent you an email earlier, Tebogo, to ask you if I had the wrong study material or something, because I couldn't find much information on the...
Sorry, Sebastiana, I didn't get the last part.
Sorry, yeah, I can't find any information on this. The information is very vague for this particular question, like on the tutorials and the CIMA reader.
Is it on any per share?
Yes, question 3.
Yeah.
Because
yes, that's why
the formula doesn't match the information, because there's so many issued shares and all of that. It's like I don't know how to start or to structure the answer.
But have you seen the guidelines that I shared with you guys?
Yeah, I went through everything. It's very tricky. I don't know how to approach it. I don't know if everybody is struggling, but I'm really battling with this question.
Other people?
I think advice that somebody gave me was to take that activity that you've given us, activity 14.2, and to put every example on a page, one for one, and look at it carefully, and then do the assignment after you've summarized the activity for yourself.
Did it help you, Louisa?
It did.
Is it? Okay, let me try that.
Yeah.
Thank you. Okay.
Can you guys see the question paper? Am I still sharing the screen? Sorry, guys.
Yes.
What's on the screen now? Is it the slide or the assignment 2?
It's the facet slides.
Sorry, guys. Okay, let's just quickly take a couple of minutes. I don't want this one. My apologies. I want this one. Okay, let's just take this just quick 5 minutes on this question. So the question requires the basic earnings per share as well as the diluted earnings per share for 31 December 2020. Okay. So if I go up, the starting point for earnings per share, you know it's profit. Okay. This one says profit before tax. Earnings per share starts with profit after tax. Just make sure you have that amount correct. Okay. Then you need shares. You need shares to. Sorry, guys. You need shares to calculate your denominator for earnings per share. So be careful to differentiate between issued and authorized. Authorized is not issued. When you register a company, the CIPC allows you to issue a certain number of shares, which is what is authorized. Issued is what is issued. So know which one is used for EPS calculation. This one we've dealt with. I think it's covered in your, when I open an EPS guideline. Yeah. Sorry, I'm just scrolling through the guideline. Number 3, example 1.6 of the guideline deals with a similar instrument. Okay. Number 4, there's not much. I think you can, because they don't tell you how that 7.6 was paid, how the company paid for that 7.6. So you can make any assumption, will mark it. There's a mistake on number 4, but like I said, I don't want to cause confusion for those that have already submitted. So what you can do, you can effectively ignore number 4 if you haven't submitted the assignment, because it will not affect both EPS and DPS. Okay. Number 5 is the right issue. Right issue is covered on your guideline. Example number example 1.3. Okay. Then note 6 is these are redeemable cumulative preference shares. So already when you see preference shares, you need to, the earnings per share and the diluted earnings per share will be determined by the nature of those preference shares. So when you see preference shares, look at note 6 of your guideline. It talks about preference shares. So these ones are redeemable. Redeemable means the money that the company has borrowed through preference shares needs to be paid back. So it's effectively a liability. Cumulative means whether they declare the dividend or not, you need to accrue for the dividend. Okay. Note 7, share options, same as warrant, example 1.1 and 1.2 in your guideline. Number 8, entered into an agreement to acquire control. 10 million is to be settled as follows. 50% payable in cash, has nothing to do with shares. So if it's cash and has nothing to do with shares, what will be the impact on EPS? You guys need to know that the cash payment. Then the balance is settled in shares. You need to calculate how many shares were issued here and the impact that those shares will have on your earnings per share. These are not potential ordinary shares, so they don't affect diluted earnings per share. These are ordinary shares. They affect your earnings per share. Okay. BEE scheme. So you establish a BEE scheme for the benefit of qualifying employees. In terms of the trustee, the trust will own 2% of the ordinary shares. So when someone owns 2% of the ordinary shares of your company, it means you issue shares to that person. So you issue 2% of your ordinary shares. Okay? The 2% ordinary shares was issued through a bonus issue to the trust. So there was no exchange. It's a bonus issue of ordinary shares. How do you deal with that? Because I think this on the guideline, I speak a lot about the bonus element. Okay. Then number 10 is a compulsory convertible debenture. What does that mean? If it's compulsory convertible, what is it convertible into?
You have to convert it into shares, into ordinary shares.
Let's say, if you read, let's continue reading. These debentures are convertible to ordinary shares on a future date. If it's convertible to ordinary shares on a future date, it means they are potential ordinary shares, so effectively affecting diluted earnings per share. So on a high level, those are what I'm testing in this assignment. Does it help?
Yes, it does. Thank you so much.
But good luck, guys. Like I said, it's a very difficult example, but let's just hope that 5-minute guideline will lead you.
Tebogo, can we expect something like this in the exams?
I'm not sure yet. I haven't decided. But like I said, this is as complicated as it gets.
Okay.
And when I say I haven't decided, I'm saying this because I haven't decided whether I would have a 20-mark question on earnings per share in the exam or not.
Okay.
Yes, Sierra?
Hi, Tebogo, how are you?
I'm very well. How are you?
Fine, thank you. Sorry, is there another way of reading question 6?
Question 6. I haven't looked at this in a while.
Is there another way of reading it because they preference shares, so they would have dividends, but that discount, is 5%.
Number 6 of
is throwing me.
shares at a discount of 5%. Is that what throwing you out?
Yes. So, I've been spending too many hours a day overthinking this question 3, about 8 hours.
No, that's fine. Let's quickly go through it. So when you issue 2 million cumulative preference shares and you get 1.9 million for it, what is 1.9 divided by 2 million?
I've got it here.
800,000?
1.9 million divided by 2 million. What's the number you get, Sierra?
1 second.
Yeah, so
1.9.
It's saying 95%. So that's where the 5% comes in. So you issue
95.
95%. So let me explain why that happens in practice. So Olga.
I wanted to say that amount is obviously less the discount already.
Yes, that's correct. So let me explain why that happens in practice. So you want to borrow 2 million rand by issuing preference shares, but the investors are not willing to pay that 2 million rand. They're saying we'll buy these preference shares, but only for 1.9. And that's why the company would issue them at a discount. So they get an instrument worth 2 million, but they only pay 1.9. So effectively meaning when these preference shares are redeemed in the future, the investor that paid 1.9 will be repaid 2 million rand, not the 1.9. So that's effectively what it means. Yes, Louisa?
Tebogo, the dividend that you pay, will it be on the 2 million or on the 1.9 million?
Good question. What do you think?
I think it would be on the 2.
On the 2 million, yes, that's correct. Because the value of the instrument is not 1.9. The dividend is on the face value of the instrument, which is the 2 million. And that's where we're trying to confuse. You need to know that principle. Then if you take, what is the dividend divided by the 1.9? What is that interest rate that you get? Sarah?
So that was my next problem.
So if you take the dividend divided by the 1.9, that will be your effective interest rate. If you take your dividend divided by the 2 million, that is your coupon rate.
So the 2 million divided by the 13%.
Yeah. Sorry.
1.9. Is
So
it?
the 13% would be your dividend divided by the effective, by the discounted amount that you effective rate.
Is it the 1.053?
So let me see the 1.53. I did get the 1.053. Sorry.
Yeah, I divided the 2 million by the 1.9.
So let's go back to the principle first. Let's not waste time on it. So the value of the pref shares is 2 million. Correct. So if I were to issue the pref shares today without a discount, it will be 2 million. Okay. Then the company says to you, you don't need to pay me 2 million, pay me 1.9, because you're negotiating and you're giving us a tough time on these pref shares. So effectively, you, by paying 1.9, as the buyer of these pref shares, there's a 5% discount. There's a 5% discount that you got. Then the company says to you, we will give you, these are cumulative, which means they will carry a preference dividend each year. Whether you declare or not, you need to accrue for a pref dividend. Okay? And at what rate do you calculate that pref dividend? At what rate do you calculate? Sierra, sorry, and Louisa, sorry, Sierra, your hand was up, so I'm not sure if it's from the previous comment or you want to answer this. But if not, Louisa, you can go ahead.
Is it not your dividend is going to be on the 2 million, not what they paid?
But at what rate do you use for the 2 million? The effective rate or the coupon rate?
The coupon rate.
Coupon rate. So in this question, you don't have a coupon rate. You need to work back the coupon rate. So how do you get that coupon rate using the effective interest rate?
Is there some way that we can find that information to get the coupon rate?
Can I try, Tebogo?
Please go for it.
Do you multiply the 2 million by the 13%?
So let me ask you this question, guys. How do you get the effective rate? How do you calculate the effective rate? And your answer lies there. I'm not going to give you the answer, but your answer lies there.
Okay, we'll figure it out.
Just work out just know the formula for your effective interest rate, and you'll be able to calculate your coupon rate. Okay.
Thank you.
Okay. I think we've spent enough. Can we move on? Are you guys comfortable with this question? Okay. So last week we dealt with business ecosystems, learning unit 1. We went into too much detail about it. Today we're going to continue and combine a bit of learning unit 1 and 2 and talk about elements of a business model. So same with last week, guys. I'm hoping for an interactive session, and we're gonna try and simplify it. We're gonna try and use a lot of example. We're gonna try and talk in a language that we both understand. Then at the end, I'm gonna give you guys a weekly task that we can use a discussion forum on my UNISA to try and complete it. But it's up to you. If you want to complete, you can. And if you complete it, I'll review it and give you feedback on the forum. I'm not sure if you guys have used the discussion forum before, but if you haven't, I'll take you to the discussion forum before the end of this class. So objective for objective for today is number 1. I've always said that every class is going to start with this. What are we trying to achieve? Okay? Then we talk about the traditional business model. We talk about the value in the business model. We discuss how we define, create, and deliver and capture that value. Then lastly, we talk about that weekly assignment. And I want to make this weekly assignment interesting. So today we're going to deal with a traditional business model. For the weekly assignment, I would like you guys to go and read about the ecosystem business model and discuss it in less than, I'll decide how many words, but we'll discuss it towards the end and just post it on my UNISA. Then next week when we start, we can start with that. Okay. So what are we trying to achieve, guys? I've said, as the SIMA name for this module is managing performance, and we're trying to manage the overall performance of the company. And we have divided that in different learning units. The starting point was the business model as a framework to understand and manage how to create value. Okay. Last week we've spoken about the business ecosystem business model. Today we're talking about the traditional ways of creating value, and also what's important in managing the overall performance of the company is understanding how do we manage this value. So you need to understand the value, then you need to know how to manage this value creation. Okay. So today we continue on key outcome 1, but we are on learning unit 2 now. So let's start with this slide. And the first slide talks to a business model. So what is a business model? Can someone in simple English, without reading what's on the slide, what's your understanding of a business model? Anyone? Sorry. Louis?
I think it's what we do to make money and how we do it.
What we do as a business to make money and how we do it. Okay, and what's the difference between the business model and the business plan? Because every time you try and start, you're trying to start a business, everyone wants a business plan from you. So what would be the difference between the business plan and the business model?
I think the business model will have processes in.
Sorry guys, I'm not able to see who's raising their hand because I can see, I'm not sure if Abel is presenting or something. Okay, Louisa, just go for
it. What I said is, I think the business model will have processes in it where we can create efficiencies as well.
The business model will have process where we can create efficiency and a business plan?
Well, I'm not trying to not look at the screen, but a business plan you will create and go to the bank for funding. That I know.
But how does it compare with the business model?
Isn't the one more the one is more the vision and the other one's more the mission?
So which one falls under the other one?
The business plan is the mission. The how do we do it?
So
and the plan is
yeah,
where we want to get.
Okay. Mr. P?
Hello.
Yes,
I
sorry.
I think a business model is a tools used within the business of activities, and plan is a document that describe a certain activities within a certain activity that will be happening within the business.
Okay. So just both Ms. P and Louisa, am I right by saying a business model will form part of the business plan? Do you agree with that statement?
Yeah, I agree.
Tavisa?
Hello?
I agree with you, Tebogo.
Hello? I think the business model is the mechanism through which company generates its profit, while the business plan is a document presenting the company strategy and expected financial performance for the years to come.
But what does that mean? Those are big words for us. What does that mean? Simple English. We want simple English.
I'm saying the business model is where the company generates its profile, which is its profit, while the business plan is where the company presenting the strategy at its expected financial performance.
Okay. Okay. Thanks. Luisa?
I think you can have more than one business model, but only one business plan. Can one say that? You can have an option of which business model, but you will have one plan. Or am I wrong?
So the business plan is the umbrella for your business. When you go and sell your business. So if you want to raise money for your business, everyone will ask you, what's your business plan? And the business plan covers the business model. Within the plan, you will develop your business model. Okay? Then the next question is your operating model. Where does it fit in now? What's the difference between a business model and an operating model?
Is the business operating model not a holistic view of all the operations that could occur in the business, different activities within the business? And an operating model is maybe for a specific function or something of the business or the model, I don't know.
So from my understanding is you're saying the operating model will fall within the business model.
Yeah.
Tire?
Because a business model is it tells you about all the operating activities within the business, how you're going to go about, who you're going to target, what value you're going to create, all of that. And then your business plan would be how you're going to go about achieving all of that, I think.
Okay. So guys, can you see the slides? There's a comment that the slides are not visible. Can you guys see the slides perfectly?
Yes, we can, but we try not to look at it to answer your question.
Yeah.
Oh, no, you can look at it, but I will reject the answer because I don't like textbook answers. I will ask you what it means. What does it mean? Abel, can you please switch off your video? I think your video is on, but you left out everything in the background. Can you please switch it off so that I can see the names on my... Thank you. Thank you. Okay, guys, I think we need to move. Otherwise, we're not going to get to everything that we have to do today. Just pop that question, Sebastiana, of the difference between the business model and the operating model. But on a high level, I agree with your answer. But I think we will try and answer it more as we go through the slides.
Okay.
So business, according to so I'm back to the slide now. A business model explains how the firm works. That's in simple English. How does the company make money? How they deliver value to customer, and at what cost do they deliver this value to customer? So through this definition of a business model, we are then introduced to a term called value. How does the company deliver value to the customer? So the next question is, what's your understanding of value? And can you give an example of what will be value that will be created to you as a customer? And I'm going to try and limit it to 2 people. So let's go, guys. Let's hear. So let me repeat the question. The business model explains how the company works. I'm reading the slide now. How the company makes money and how it delivers value to customers at an appropriate cost. So the question is, what is your understanding of this term value? Yeah. And can you give an example of, as a customer, what will value?
Can I take a stab at this, Tebogo? For me, value to a customer is like what makes your product different than the next person's product. So you have to convince me why your product is better than the next person's product if it's the same product. And for me, value is also the service that goes with that. Like, what service are you going to give me after the product? For example, when I buy a car, when I come for maintenance, what are you going to offer me that someone else can't offer me? So that's how I see like value creation. Like, what will you do different that someone else can't do for me as well?
Okay, Louisa?
I think it can also be perceived value. Say if you purchase a certain brand of jeans, the image that you project wearing it, I think that's also value maybe that's generated.
Okay. Tabitha, last one.
The faster the better. The first way to create value is simply the increase the speed you deliver, the kind of value people are willing to pay for. Yeah.
So you link in value to the speed of delivery, okay?
Yes.
No, that's fine. So let's get back to Louisa. Can you just repeat your answer there, please?
Sorry, did you ask for me, Tebogo?
Yes. I just asked that you please repeat that answer for me, please.
I said if one, for example, purchase a certain brand of clothes, you don't just get a piece of clothing, you also get a perceived image of how people will perceive you if you wear that specific jean. I don't know if I expressed myself correctly, but it enhances who you are or how other people see you if you wear that specific brand, or that's what you think.
Sebastiana, sorry, can you please repeat that answer?
Well, for me, it's just what are you going to offer me that someone else can't? Like, for example, I would use Woolworths. they're all about quality and not quantity. So they will ensure that I get the best quality products. That's why they're more exclusive or whatever. So that's the kind of value that they will offer me, being an exclusive customer or something. So they would be better than a Truworths, for example.
Okay, no, that's fine. So if I summarize the three answers, Pravisa said the speed at which the product will be provided to a customer. Louisa said the brand or the enhancement, the perception it will create, and the value it will add. Then Sebastiana is saying what you offer me, how does it compare to what someone will offer me, and how is it better than what someone is offering me? And those are the three answers. So let's look at what Seema is saying is value here. And if I go back to, and I'll come back to your answers. Okay, if I look at this diagram, back to the slide. So if we look back to the slide, the value is right in the middle of this diagram. Okay? And it's the only way that written in caps, if you notice that. So we start off by saying define, create, deliver, and capture. Okay? So if we remember last week, we did a business ecosystem. And our starting point of a business ecosystem, we defined what markets were. Remember when we spoke about what is a market? What is a physical market? How has it changed compared to the virtual market that we see? Then we went on to talk about the technology that's driving the change in markets and change in customer behavior. And we started talking about what we termed the digital customer. Okay? Then we moved on to talk about the risk and opportunities. We said if you don't adapt to this technology, chances are you will not succeed in this market. You need to try and adapt, and if you can't adapt on your own, you need to align yourself with people that can adapt through the business ecosystem. And by joining that ecosystem, opportunities might be endless for you. There's also certain risks that you might face. You are sharing your IP. People know the way that you conduct business. Then we also spoke about the regulation by the legislators, by government enforcing the legislation under risk and opportunities. Then we move to the society. The society is how the customer behaves, the patterns of behavior. What does the digital customer expect, and those type of things. So the business ecosystem at a high level falls into this business model, but it's not the subject for today. That's the homework that I was referring to. So value is in the center of the business model, effectively meaning whatever we do in our business, we want to extract value. Okay? We want to extract value, or we want to create value, we want to deliver value, we want to capture value, we want to define value. Okay? So the definition of value from a business perspective needs to be aligned to who the stakeholders are. See, it's very difficult to define value, and that's why the three of you came up with different answers. It's very difficult to define value if you are not linking it to a stakeholder, because the value will be different depending on stakeholders within the business. Am I making sense, guys?
Yes, Tebogo?
So before we even define value, before we even define value, we have to define it relative to a certain stakeholder. And we need to prioritize those stakeholders as well. Okay, and through this process, that's what we're trying to do. We're trying to define what value we want, okay? What value we want to create, and what value we want to deliver to our key stakeholders, and what value are we trying to capture. Okay? So what do we mean? So let's start at the end point. Capture value. How will a company what will be an example of a company that has captured value? And guys, try and state it in simple English. When I say I have captured value, what do I mean? Louisa?
You've made money.
I've made money. Okay? So what is the measure there? My bank account. I've got money in the bank.
And the market share as well, I think.
So I've got money in the bank, Sebastian.
I think that your customers returning.
Customer return.
Your stakeholders, when they return, that means they're happy, I guess.
Yeah, and Tire, you wanted to say something there?
I said I'm agreeing with all of them, but ultimately, when you have achieved a certain market value, maybe market value of the company is increased. That'll be the value of the company. Yeah.
Okay. So let's look at the stakeholder. When you've made money, Louisa, who have you made money for? Who has the business made money for?
Well, you've made money for yourself, for the people working for you.
The shareholder.
If you're the
employees.
if you're the owner, you've made money for yourself. You've made money to pay your employees. You've made money to reinvest in that business. So for shareholders, you would have made money.
So that's fine. So you've made money for your shareholders, you've made money for your employees through your incentives, you've made money for reinvestment. Sebastiana, in terms of your customer and stakeholders return, who have you created value for?
For you, well, your stakeholders, for yourself as well, and your customers returning is all your stakeholders. Your it could be suppliers, it could be your customer, it could be anyone, and for yourself as well, and your shareholders.
Okay. But most importantly, I think on your answer, I wanted to highlight the fact that you have created value for your customer.
Yes. Well, your customers,
And your customer, you saying, once you create value for your customer will return.
Yes.
Okay. Then, so we've looked at that. So your value has to be aligned to your stakeholders. That's why we have different values, different people that are benefiting from this value that we've captured. Okay. So if we, and I'll get back to the both of you, Louisa and Sebastian. So if we return to this business model, so can you guys see my arrow when I play with the arrow?
Yes, we can.
Okay. So we spend time on capturing value. So capture for who? We said we captured for employee, shareholders, and to reinvest. So when we reinvest money into the company, what do? We buy machinery or we improve our processes. And the ultimate goal is to start this circle again. You see that? So I reinvest money, I try and define my value, I try and find ways to better create my value or find ways to better deliver my value, then I capture more value. Yeah? If my employees are happy, they will create value better than they did initially. If I keep my shareholders happy, they will keep investing in the company, and it will do this. This will keep turning. Okay? If my customer is happy and is returning, he will buy again, and I will capture more value from him. Do you see why this thing is a turning wheel? Do you guys understand that?
Yes, we do.
Yes.
Yes.
Okay. Luciana, you've got a question there?
No, I just took my hand off. Sorry, Tebogo.
Luca, you had your hand up?
No, I removed it. I had it on all the time. My apology.
Okay, no, that's fine. I think so. So let's start by talking about this big thing that we all after. So the company wants to make money, the shareholder wants to make money, the government wants a piece of your company, the employee wants to make money, they want their bonuses, the customer wants a product that will satisfy his needs. See, so those are the different stakeholders that are looking for this value in the company. So if you have a product that does not create value for the customer, what will happen to this wheel? So I create.
It won't turn. It will either get stuck somewhere and they're going to have to re-look at their business model, or to have another plan, because if something doesn't work, then it won't. It's like it's kind of a ripple effect. Each one has a ripple effect on each other, like technology has a ripple effect on the possible risk that's out there, like create, deliver, capture, and define. If one does not work, it will have a ripple effect on all of them.
That's correct. I think if I lose my employees, I might lose the know-how, and I need to employ new people and start teaching them how to produce the goods or how to manufacture the goods. So that's affecting my value that I capture. My value might reduce because it takes time for me to invest in these customers. If I'm not giving my shareholders a dividend, they will walk away. They will sell their shares. Okay? If I'm not delivering a quality service to the customer walks away. They are not loyal to me. They're going to go to another customer, to another supplier, or to another company. So my value, I would not have any value to capture because I don't have any customers. The world will stop turning. And it's important that our business model is focused on value. The way we structure our business, the way that our business works must be focused on creating value and to keep on creating, delivering, and capturing value for all the stakeholders involved. And you can prioritize the stakeholders as to who's important for you. I mean, you hear, most of you have had this when you walk into the shop and you arrogantly say to whoever's working in the shop that the customer is always right. I mean, most customers do it. They walk into the shop and say, the customer is always right. We've had that so many times. But that doesn't mean that's necessarily right. It will depend on who you have identified as your stakeholder. If you prioritize that stakeholder over everyone else, and we'll deal with how to do that and what it means to prioritize as stakeholders. So guys, this is what this lecture is about, this whole diagram. And it's focused on that value. How do we deal with that concept called value? So if we move to the next slide, so it says value is the heart of the business model. And we've already seen it was in the center of that wheel. Yeah, it was the only thing that was written in caps to emphasize that it's the heartbeat of the business model. Okay? And value can be financial or non-financial. So these are the different forms that value can take. And you can try and link these different forms to each stakeholder, but for the purpose of this slide, we're going to discuss the form that this value can take. Number one, it can take financial or non-financial. Financial is when you make profit, it can be measured through profit. You can look at your books and say, I've made a massive profit, so I've generated value. This company has generated value. Okay? Profit can be from a high turnover. High turnover means I'm selling more goods. It can mean I'm selling more goods, or the price of the goods is high. But if your customers are willing to pay a higher price for your goods, it means there's something that they like in your goods. I'm keeping my cost low. Means the way I operate this company, the operating model of this company is so efficient that my costs are very low and I can extract more value from this company. So price, cost, profit, cash, these are the financial measures of value. Then you have the non-financial measures of value. You're looking at customer loyalty, market dominance, employee turnover. If you can run a customer satisfaction index, you can calculate or do a customer retention calculation of how many years have this customer been a client of the company. So those are the things that you can use to calculate the customer loyalty. Market dominance. You can get your marketing team to tell you what percentage of the market do you dominate. If you dominate a higher percentage of the market, it means people like the value that you are offering. The market likes it. If the market likes it, it means the customers are happy with it. The employee turnover. The higher the turnover, it means the employees are not happy. You are turning employees quickly. Employees are leaving your company. Why? They don't derive. They might not see the value that's being created for themselves within that company. So those are the non-financial measures of value. Yeah. Questions on the financials and the non-financial? Yes, Louisa?
Tebogo, if you look at the community as a stakeholder, say, for example, somebody will discard oil in a river and it will be bad for the environment. Where will this, obviously you deteriorate value, you don't create value. But where will that principle fit in here?
So it doesn't create value, number one, because it erodes value.
So I must maybe use another example. Say you do something to promote clean rivers or plastic-free oceans as a company.
So,
it will be probably.
So let's unpack that. So you do something that is environmentally friendly. Yeah? And is that how I'm understanding, or am I correct by interpreting your question like that?
Yeah, you're correct.
Okay, so as a company, we do something that is environmental friendly. So first of all, we stakeholders are going to be happy with us doing that. You've got these environmental groups that will be happy with what the company is doing. And when environmental groups are happy, they will talk about you. They will talk about the company. Then the company will receive publicity, positive publicity. And as a result, it might create value for the company. It might attract people that don't even know the company to start looking at the company and start seeing what service they are offering and wanting to engage with that company.
So I think what I hear is that, sorry, can I talk?
Yes, you can. Then Sebastian afterward.
What I hear is that you must continually engage with all the stakeholders so that you can be one step ahead of what is it that they want or what they value, so that you can create that value and turn the circle again and again and again in your favor.
Yes, that's correct. That's why the wheels keep turning. That's why the wheel keeps turning. Sebastiana, then Tabisa.
What are the causes of employee turnover?
Can you hear me? Yeah, so
I'll answer your question. Yeah, Sebastiana.
Yes.
yeah, Tebogo, I was going to say that that would be part of your business model, like corporate social responsibility. And you get points for that. Like for example, it could be part of your BEE points as well. It would be part of your business model. So your whole business model is how you're going to create value and what you're going to offer and all of those things. So by doing that, by taking care of the environment, you're taking part of the community, which is your social responsibility. You're taking part of the environmentalists, so you get points for that as well. So that all creates value. So it's actually kind of indirectly promoting yourself.
That's correct. So you get free marketing. Get free marketing by not free marketing, but actually you get marketing by
Exactly. You get good reviews. Yeah.
Yeah, that's fine. Kamisa, you asked what causes employee turnover, a high employee turnover. So what is a high employee turnover? Let's start there, Kamisa.
No, I was asking a question.
So what is a high employee turnover? What do we mean by a high employee turnover?
More productivity?
No.
No.
Susan?
I think it's when people, they will work at the company for 3 months and then they'll resign. And it will happen continually in that environment, and you need to find out, why do the people with the skills don't stay? What makes them so unhappy? Is it their salaries? Is it the corporate culture? Is it the values of the people in the company? Is it the physical environment in which they work?
So to summarize what you say is, they do not see value in what they do for the company, or they see the company as not adding value to their employees or to themselves in this case. Am I correct by saying that?
Yes, or I think
you are. Sorry, I misunderstood the question that what the lady asked, Avisa. But yeah, I agree with you, Tebogo.
Okay, that's fine. And Louisa, Tabisa, do you agree? Do you understand the concept?
yes, I think also
Yes.
employees can also think maybe they can do better or get more value from somebody else who's prepared to give more. So they will market themselves as well to to move to greener pastures.
Yeah, no, that's fine. So, guys, I'm gonna ask you that for the rest of the class. So let's stop using profits, money, what. Let's start using the concept value. So I'm gonna replace all those things and say use the word value instead of money, and let's see how our answers are. Because the thinking here is in this chapter, I think they have complicated a simple term by not defining it in simplistic way. You see, everything that we've been talking about, customer loyalties, what, let's try and replace them with the word value, and let's see how whether our answers are aligned to what's in this textbook. Do you guys agree with that approach?
Yes.
Yes.
Lisa, you've got a hand up.
So if we look at it from that point of view, I would say if you work for a company and you are a mother and they have childcare facilities over and above at your workplace where you can have your children enrolled close to work at a reasonable rate, that will add value to you. Yeah, I talked about money again, but the benefit of having your children close by and cared for can be a perk for a company which will retain you to be an employee at that company.
Yes. Just before you go, so what value is that? Is that a financial or non-financial value?
I think it's a non-financial.
Yeah. So those are the things that will fall under non-financial value. So that's exactly what we're trying to do in this slide. So we replace all these things that we call benefits and lack of benefit, profit, cash, with the word value. And everything will become easy to understand in terms of what we're trying to do in this chapter. Okay, so let's move to the second column, the tangible and intangible. So what is it? What does the word tangible mean? The difference between tangible and intangible. You can even use assets to define it.
Tangible
One you can touch and the other you cannot. Physically touch and intangible you can't touch.
Okay, Peter?
Yes, I wanted to say the same, that one you can touch like machinery, you can touch, and then intangible will be something that you can't touch. That'll be maybe
So,
like
okay, no, it's fine. I agree with the both. So the other one has physical form, the other one doesn't. Okay. Then let's bring the concept of value into an intangible asset or an intangible value. What will be an intangible value? What will be a tangible value? Lisa?
I think that's that example of purchasing a branded piece of clothing where your image is promoted. That will be intangible.
Okay, that's correct. And your example about the workplace where they've got a facility for your kids, is that a tangible or intangible value?
I think it can be both because it gives you peace of mind because your children is close. That will be intangible. Tangible will probably be a lower rate, a subsidized rate.
Yeah. Oh, so look at it from a company's perspective. So if you are happy, what are you adding to the company?
I will work very hard for them, and when they need to be helped, I will help them because they help me. So I'll be motivated. and I will be productive.
So it can be tangible, it can be financial and tangible in the sense that if you are, for example, a manager of a team and you've been allocated a budget, by you having that facility at work, you can easily meet your budget because you don't have to worry about going home and looking after your kids. You know that your kids are looked after. Then all you do is just pump, work during the day to make sure that you meet the financial target. Okay. Tira, your hand was up, and I think Sebastiana, your hand was up as well.
Yes, I wanted to give example of in the first column to say that customer loyalty and market dominance. For me, I would say that is intangible value. So I'm not sure about tangible, if I can say maybe profit, although it is maybe in the bank. I'm not sure if you can say it is touchable, it's something that you can touch. But then for intangible, I'm looking at that customer loyalty and the market dominance for company.
So I looked at this. It looks like the financials are tangible and the non-financials are intangible. That's the conclusion I came to. And you guys are more than welcome to challenge me on this logic.
Yeah, that is what also I'm thinking.
Anyone else? So let's look at it at the country level, the macroeconomics. What is this industrial economy and knowledge information based economy? What are the difference between the industrial economy and what we call a knowledge-based economy?
I think an industrial-based economy is where things are actually being produced, like your manufacturing industries and all of that. So it's like very physical. And a knowledge and information-based economy is like, for example, the COVID-19 vaccine. That would be an example of that. Like you have the knowledge of how to produce that. So it's not necessarily physically producing the vaccines, it's knowing how to do that. So it's kind of offering that service, like you have specialist scientists or whatever that knows about all of this information. So it's kind of sharing information with the rest of the world or something on a macro level.
Yeah, I agree with that answer. Louisa?
I think it's that saying for work smarter, not harder. So you find new ways of doing something and then you create value because maybe you're the only company who can make a certain part for a car, and then you have a patent that's yours that you can register. So you will be more competitive out there by using knowledge and information instead of just trying to work harder or produce more.
Okay, agree with that. So in the current setup or in the current landscape, which one has more value, or where do we see technology taking us to? Are we moving towards the industrial economy, or are we moving towards the knowledge information-based economy?
The knowledge, because everything is replaced with machinery anyway. So you need to be that person that tells the machines what to do.
So you need to be innovative.
Yeah.
So
we're moving towards that era now. Like, okay, it also depends again on what the company's needs or requirements are. If you are capital intensive or have a capital intensive economy, you're going to always be stuck in the industrial economy. But even that is being replaced with machinery. So we're definitely moving towards a knowledge and information based economy. Well, we're still getting there.
Okay. Louisa?
I also think more to a knowledge and information-based economy because of the global trends. There's no more barriers to trading. We can cross internationally. We can move and do business.
Okay. Where's Sierra today? Sierra? She with us.
Hi.
Hi. Sorry.
Hi.
Okay. No, I was wondering where you are. So.
No, sorry. Apologies.
No.
I'm still fixated on the discount rate. It's one of those. So I am concentrating, but I'm also worrying about finishing. So that's why I'm quiet. But I'll actually. Sorry for the honesty, but I'll actually. I have been listening, but I will like to participate.
No, that's fine. No worries. No worries. So this value so what would be value in a knowledge and information based economy? So Sebastiana gave us an example of the vaccine, someone that come up with a vaccine and someone that manufactures. So between the two, between the guy that manufactures the vaccine and the person that develops the vaccine, or that comes up with the vaccine, who do you think will capture more value?
The guy that engineered it.
Yes. Because even if he doesn't manufacture it, he will still get royalties from it. First of all, they need to buy it from him, and
Exactly.
there's also royalties.
Exactly.
Okay. Then value can be past, present, and the future. So what is past value? What do we mean by past value?
Maybe, I don't know, doing something different, or looking at past experiences. How is that, like maybe, for example, the flu vaccine or the TB vaccination or something, those were past things, and it probably added value to the new, I don't know, maybe I'm totally out here, but yeah, I would think looking at past experiences and the wins from past value and how that will, or how it can help anything going forward.
I think you might be a little bit off here. Louisa, let's hear what you have to say.
This is now a long shot, but like the term of a sunk cost. If you've purchased something, but not necessarily for a specific purpose, and you can re-engineer it for something else and generate money from it.
Yeah. So I'm trying to simplify it for you guys. So past value, the way I understand it, is your financial statement reflects past value. So if I read the financial statement, if I pick up the financial statement for any company for last year, is that not past value?
It is, but it's not, I don't know, do you still think it's efficient for us to still work on historical cost basis, like for example your financial statements? I mean, we have to now think about going forward, right? How we're going to sustain the business in the future, and working on past numbers or the financial statements. So that's more like for me, I think it's more like something that occurred, like it's there and it's I don't know how it will be of value going forward because things are changing all the time.
So you're saying historical numbers don't have value. So why are we producing?
Well, not anymore. It's constantly changing. So yes,
But
we can look at those numbers, and maybe it was great back then, but maybe now at this present time, maybe we can use it as a tool to go forward and see what we can do differently. So maybe it will add value in that sense. For example, when you're doing your budgets or whatever, like what can you do differently? But as far as
so based on your last sentence, it does have value.
well, you can use it as a tool. So yes, there is some value there to a certain extent, I think. It depends if it was in your favor or not.
Yeah. But don't the financials detail the value that you created in the past? So it's reporting the past value. So forget about whether you can use it going forward or not. Is it not a reflection of the value you created in the past?
Oh, absolutely. At that point in time, yeah.
And I think that's what you mean by past value. Louisa, your hand is up.
I think I was just thinking now, if you look at the figures, you can see trends, and that can help you to better plan. If you can identify a trend, maybe in your cash flows, say if it's seasonal, or how the people that purchase, how their behavior change, maybe it will reflect in your figures, and then you can apply that analysis and maybe get a better return or do things different.
But you guys are using past values to determine your future value, your forecast, and to determine if I invest in this company, what would be my return? So that's what you guys are using past values for, as a basis for your future values. That's what I'm understanding your answers to be saying. But my question is, what is past value? What are the historical numbers used? If I pick up a set of financial statements, is there no value in reading that set of financials?
There is value to it because it will give you the position of your company. It will tell you where your company is at that point in time. So it does give you value in that sense.
And you can also decide if you look to purchase or acquire another company, you can look, will it be worth your while based on their figures?
So based on that, so now you're moving to the next phase. So you will take the figures and add the forecast to it to determine your future value that you can then apply the present value or whatever valuation you want to apply for an investment appraisal. Yeah, and that's why we've got past value as well as future value. So let's talk about present value. The numbers that are presented in the management accounts, those are present value. Today, we're sitting in a board meeting. Louisa presents management accounts for end of July. So what value does that have for the company?
Well, we can see whether we are on track in terms of what we do, or is there any variances over or under expenditures?
Yes, I think that's when we read management accounts, we talking about how is the current performance. We measure performance as it occurs. We do not wait for the end of the year to see how we perform. So there's value in the sense that we can take immediate action. We can step in if things are not going well. So that's why we have past, present, and future value. Then we have short term and long term. I think the short term and the long term are self-explanatory, unless someone wants me to explain them. Okay. So now the next part of this thing is, how do we define value? We've gone through this. We've discussed the forms that value can take. We've seen different forms that value can take. So now we're starting by saying, let's then define this value. What is this value that we've been talking about? We know the forms that it can take, but we want to know what this value is. Okay? And to define a value, we need to link it to stakeholders. You need to know who you're creating value for and what counts as value for them. So if I'm doing it for a customer, I need to know what does the customer want in simple terms. Who am I creating value for? For example, a customer. Do I know what a customer wants? If I create something that a customer doesn't want, it will not create value for him. So I cannot define value in isolation of the person that I'm creating it for. So in defining a value, what it says is we need to start by identifying who our stakeholders is, what their specific role is, prioritize them in terms of their, in terms of how the firm responds to their demand. So let's stop here. So these are big words. Identify stakeholders, we understand. We'll touch on how we go about identifying the stakeholders and their specific role. Prioritize them in terms of how the firm responds to their demands. So let's take, for example, a customer. How does a company respond to the customer's demand? This is a quick one. You are a customer, you want a company to respond to your demand. As a customer, what do you want? You want a product or service, and you want a company to respond to your demand. And I'm saying, how does a company do that? Louisa?
I think you want quality, so they will have a customer services channel where you can complain and give them feedback. So in a way, they have a channel to hear what it is, what you want, and if you're unhappy.
Okay. So there's various ways of how you can respond to a customer demand. Sorry, Sierra?
Hi, I think the customer is looking for immediate response.
So yeah, so immediate response can be one of them. Remember last week we spoke about the needs of a digital customer. What does a digital customer want? And we went about trying to respond to those needs through the business ecosystem. So you need to prioritize those demands. So your value creation, ultimately you're creating value. I think for me, if I was running a business, my priority stakeholder will be the customer, because the customer is the one that's paying. And whatever, so I'm providing a service and the customer says, I'm happy with your service, but 1, 2, 3, 4, 5 is not working. And I need to respond to those things that are not working. And the speed is one of the factors that I need to take into account. I think Thabisa mentioned it in one of the questions that we had earlier. So the speed at which we respond to customers' needs. If we don't respond on time, we lose the customer. Okay? Then you guys need to know what stakeholders are. A company can have many stakeholders. A stakeholder is a person that has, in this case, a stakeholder will be a person that has interest in the company, or a person that if the company does not have support of that person, the company might struggle to continue. And what are the different, so let's just talk about stakeholders. What are the different types of stakeholders we have in a company? Let's just put them in Louisa. You can also, guys, some of you are quiet, put them in the chat box. What are those stakeholders?
I think suppliers, because if you don't have a product, you can't sell it. So you'll also have to prioritize your suppliers.
Suppliers, yeah.
Customers, so that they can buy your product.
Customers, yes. Lindiwe and Sebastian are saying employees are stakeholders. Okay. So how do we identify? Remember, we're still defining value now. And we're saying to define value, we need to know who we're creating value for and what counts as value for them. So who are you creating value for? We need to identify stakeholders. So to identify stakeholders, how do we go about doing that? The textbook talks about two approaches. Okay? There's a traditional approach to stakeholder analysis, and there's also the more modern approach to stakeholder analysis. And if you look at the slide, the traditional approach is that Middle's metric. Then the more modern is the 4-step approach. So the traditional approach talks about, it looks at power and the level of interest. So can the stakeholder influence the business plan or the business strategy of this company? That's power. Secondly, how interested is that stakeholder in the performance of the company? So you might have power, but not interested in sort of changing the operations of the company. Or you might be interested in changing the strategy, changing the governance of the company, but you don't have the power to. So this traditional approach talks to all those people. It identifies them using this matrix that looks at power and influence. So it starts by saying there's low interest, low power. So people that have low interest means they are not really interested, they are interested, but not really interested in the performance of the company. And secondly, they don't have power to influence the company strategy or the governance of the company. So it gives an example of very minority shareholders, someone that owns 0.1%. For example, if you buy shares on the stock exchange now, okay, you are interested in how the company is doing. You are interested in the company strategy. You are interested in the corporate governance, but you can't influence it. You are not interested to the extent that you're gonna go and read a detailed strategic report of that company. You just bought shares. I think most of the people buy shares because the company is in the top 40. Most people, when they look at their pension and they ask them, where do you want us to invest? They'll probably say, go for the top 14 on the JSE. So you are a small shareholder. You can't influence the governance. You can't change the company's strategy, but you are interested. You understand that first level. Guys?
Yes.
Okay. So what will this small shareholder be looking for from a company? So what value will this shareholder want to derive from this company?
A return on investment.
Return on investment? In what form? In the form of a dividend or in the form of a capital growth?
Dividends? Depends on the nature of the business.
Yeah. It can be both.
Yeah.
And in terms of anything in terms of non-financial?
I'm thinking of long term as well, so that it will be a return on investment, but not in the long run as well, maybe.
So it's a long-term value. Yeah? Is he looking for a tangible or intangible value?
Tangible.
In terms of return on investment, okay? What if it is invested to be associated with that company?
But if the interest is low, do you think it will matter whether they want to be associated with it or not?
It depends. Depends. So there might be a non-financial, intangible value that we don't know. And that's why we need to understand our stakeholders. See, on face value, it looks like he's interested in ROI. Okay, but there could be other non-financials and non-tangible. And those are very, very difficult to identify if we don't understand our key stakeholders. I mean, for example, First Rand has a lot of shareholders because it's listed. So they will not know what is the intention of each and every shareholder on their books. But the assumption would be they want the ROE, the return on investment, ROI. Then the next set is high in. I'm only going to deal with the first two because we're running out of time. Then you guys will follow through. Or alternatively, we can continue with this class next week. I'm not sure how you guys want me to deal with this. Any suggestion? Do you want me to continue dealing in detail or just highlight the first two and move on to the next slides?
Will we get through everything, Tebogo, if we go at this pace?
No. Even if we speed up, we won't.
No, I think then we must go on our own, and then
okay.
Maybe if we can, Tebogo, if you can give us that activities to do, so that we can just test our own understanding, and then.
Yeah. So let me quickly highlight so that when you go through this slide pack, you don't go through it blindly. Nozipo noted. Let me quickly highlight so that you don't do it blindly. So defining value, we've already said the critical part of it is identifying who your stakeholders are. So these two approaches talk to identifying your stakeholders. And the way you identify it is different per approach. Obviously, this being the traditional approach is to a certain extent outdated, and the more modern one will be preferred, but it's still relevant. So understand how you identify those stakeholders, the ones that you want to create value for. And once you've identified them, you will then understand what value they want from you as a company. For example, let's look at the 4 steps approach. It says identify relevant stakeholders, and those can be customer, supplier, shareholder. What does a supplier want from you as a stakeholder? What will the supplier want from a company?
He wants to be paid on time.
Guaranteed trading.
Well, can you provide that? Can you provide that? He might want it, but it will be difficult for a company to provide guaranteed trading.
Well,
on his performance.
Yeah, if you're doing well, I guess the customer will have peace of mind that, you will always order from them and they can supply you with these goods. Also, as far as paying them, like Louisa said, that your company needs to be doing well and be okay for to pay them. So you must have a good cash flow.
Okay, no, that's fine. You can guarantee, but yeah, suppliers want to be paid on time. When they deliver the goods, they want their money. As simple as that. Then the next part is rank and prioritizing them. There you see also power being used to rank the stakeholders, legitimacy and agency. I think those terms are defined in the textbook. Power is the ability to exert your influence. Legitimacy is, are you accepted as being important? For example, let me give you an example of legitimacy when it comes to government. The fact that we recognize the government as, or the current government as our government, it makes it legitimate. So you lose legitimacy when you don't get recognized. Then there's also agency in terms of providing whatever is required from you or whatever you need from the company. Most companies tend to say customer is the number one priority. I agree with them, and I would like to hear your views. You can post them on the discussion forum. Customer is the person that brings in money. So for me, I would make him my number one priority. Okay? So defining value is all about identify and ranking them. Then the next slide is how do we create value? This value creation process. So the other word for value creation is the operating model. And that's why I was asking you guys, what's the difference between the operating model and the business model? So effectively, the operating model falls within the business model. Back to what you were saying, Sebastian. It falls within the business model, but within the component of value creation. So how do you create this value? It's effectively more or less the manufacturing process, or the process of getting from your raw materials, or the process even before raw material, the process of starting with zero and ending up with a product that you can sell to the customer. And that's what value creation is. So you've got your partners, you engage with you. First, there's a customer, comes to you, they want goods. You need suppliers that can manufacture that good. You need subcontractors that can add whatever needs to be added to that goods. And it says you need to add and their trust and reward them appropriately. This is what we're talking about now. For example, your suppliers want to be paid on time, and they need to know that if they deliver, you will pay them. Okay. Resources, these relate to your input. For example, SAP, the textbook makes this example. It says SAP Miller, their input, their biggest input would be water. They need to be able to secure that water. And they don't just wake up and say, we're going to buy water. They need to have relationships to ensure that that water will always be supplied, as and when they produce the beer. ESCOM uses coal. They need to make sure that the power station have enough coal to generate electricity. That process has to be managed. They need to build a relationship with those suppliers at the power station and make sure that whenever coal is available, I mean, we had an issue where there was coal, but apparently it was wet because it was in the rain and they couldn't generate electricity. So those type of things need to be managed.
So for the cloud should be the intangible stakeholder.
So which one?
The clouds, to guarantee them no rain.
Oh, in the terms of, yeah, but you can't control them. That's the problem.
Oh, okay. So it's about control.
Or being able to build relationships with them.
Well, we can pray to the gods.
You can, we can pray. Then the process is the conversion process. How do we convert input into output? So how do we use coal to generate electricity? How do we convert water into beer? So this is the processing. Yeah. Then activities. Activities is the way to better our processes. And this can be linked to the way a factory operates. For example, if we have a under recovery in a factory, what does that mean? It means the factory is not utilized fully. So you need to find ways, engage with people to make sure that your factory is utilized fully. You need to streamline your business processes, implement new ERP systems that can. I think in the ECP exam we had a question where the company just implemented a new ERP system that streamlined all the business processes into one system. And ultimately, what comes out of this process is a product that we're hoping it will satisfy the customer needs. So after we've created value, we're hoping that this output will satisfy the customer's needs. So creating value is all about producing the goods or providing the service. Sebastiana?
Sorry, Tebogo, I was going to ask you, could this be a potential long question? Like, how can we create value in a business? If you're going to give us a scenario, maybe, or will it possibly be, can you unpack this into different questions? Or should we just know everything?
In terms of questioning, I'm not one to ask you how would you create value in a company. I would give you a scenario and I say apply value creation into this scenario.
Okay. Could it be an integrated question as well, Tebogo? Like maybe, for example, you can say what ecosystem is this and how can we create value or something?
Yes, yes. So those are the type of questions that I would ask.
Okay.
Then the next phase is delivering value. How do we deliver the value? So that output that we've generated through the creation, how does it get to the customer? Okay. And it talks about the traditional segment, the value-based segment, and different channels. Okay. So last week, we spent so much time on what I may refer to channels that have been influenced by technology. So thus creating new virtual markets. So understand how traditionally these channels used to operate and what impact has technology had on them. So value-based segmentation is just looking at a group of customers and say, how do these customers view my product? So if I put them together, how do they view the product that I sell to them? And is it worth it for them? And what is the cost of me establishing this relationship with them? So if the value that you create or the value that they perceive to be generating from this product outweighs the cost, then you will continue providing these goods, delivering these goods through these value-based segments. Okay. So I see in the study guide, channels are not discussed. I need to speak to Yaku, who was the previous lecturer, just to understand whether this forms part of our syllabus or not. But in the textbook, in our study guide, it's only the traditional segment and the value-based, the customer segments that are discussed. So I'll get back to you on these channels. Yeah. But for completeness, just understand them. Then capturing value. value captured when you capture value when you earn revenue from the delivery of goods, and that revenue exceeds the cost of creating. And how do we measure that residual value? The residual value is your revenue. So in the next chapters, we're going to deal with the costing of your products, and we're also going to deal with the pricing strategies. And that ultimately will lead to the residual value. So let me pause here and go back to the slide. Because if you look at key outcome 4 touches on the costing, the application of the life cycle costing, and selecting price strategy. So it's effectively looking at these 2 components. And just remember this when we get to those sections where they fit in terms of capturing of value in the business model. Cost depends on efficiencies of the process, level of activities. I don't want to rush the slide, guys. I don't want to rush the slide. So I'm going to stop here and start here from next week. Okay. But what I wanted you guys to try and do for next week, not in too much detail, is just don't spend too much time. If you spend more than an hour on it, you are overdoing it. So it's just to state that how would you do the defining, creating, and delivering and capturing value in the business ecosystem, not in a traditional market, but in the business ecosystem. And just type it there under your discussion forum. You guys know how to use that discussion forum.
We do. Oh, I do.
Just quickly log on to my list. Sorry, I'm trying to log on to my user here.